Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today would be the man himself, the governor of the great state of real estate in Texas, Mr. Michael Becker, but he is on another due diligence assignment. So in the podcast with us, we're blessed to have Mr. James Eng. James, the Professor Eng. How are you today?
I'm doing good. I just got off a phone call and the guy said, are you the doctor? I'm like, no, professor. He was like, all right, got it.
Oh, that's a good one. Yes, you are the professor, because if you weren't doing commercial real estate, you'd be teaching senior level college history, teaching everybody the right way of how the West was won, so to speak, and all the history that goes behind all the history lessons that James knows. So, James, what a great Old Capital Conference for 2023. We are still basking in the glow of it. Tell me a little bit about your thoughts about coming into the conference, the takeaways, and then we'll talk a little bit about the conference itself and some of the highlights. So go ahead.
Yeah, I mean, I think the 2-day conference really feels like trying to close 10 deals on 2 days. Just everybody coming together across the industry. I think that's what's unique. It's not a lending conference. It's not a listing broker conference. It's not an owner's conference. It's everybody. And so having listing brokers, lenders, owners, GPs, LPs, property managers, sort of everybody who is in this industry who are actually doing deals was there. So on Wednesday night, we had a happy hour, probably 300 plus over in Addison. And that was, I feel like this happy hour gets longer and longer, and at some point it will be longer than the actual conference. And so the first year we started it, it was maybe an hour and a half, then it went to 2 hours. This year I opened it up to 3 hours, and I thought 3 hours was enough time. And then we just kept the bar open. I think we were there till 9 o'clock. We started at 5, and some people got there before. I was there very early, but some people got there at 4 o'clock. So
it was like your cousin's wedding where the bar is open and everybody takes advantage of your uncle. So it was a lot of fun. Go ahead.
So I thought that was good because for us, we're sort of running the show on Thursday and making sure the speakers are there, making sure but the happy hour, we're just hanging out just with you guys. And so I love the happy hour. Get to talk and meet with everybody. And we had one of our guys, Lane Bean, help us find some of these flight suits. So the whole Old Capital team was in flight suits. So I thought that was extra fun. And then you came up with the idea. We had a big screen, TV and monitor sort of surrounding us. And we talked the venue into playing Maverick Top Gun for the whole deal. And so that really just sort of set the tone, I think, for the conference. And
because we were talking about the best of the best, and everybody has a little bit of a maverick inside of them. And so we really were talking about Top Gun, best producers, best operators, best management companies, best of everything, being in the flight suits. I mean, these were actual Air Force flight suits that we were able to wear. And we had patches on them that said Old Capital, and you had the professor patch on there. I had the Godfather patch, and everybody else had their different patches on. It really stood out as just a really classy and wonderful event. Keep going, James.
Yeah, and I mean, we had told people that was the theme for the night. And so we had people in leather bomber jackets. We had people in their own flight suits. One guy texted me and was like, are people actually dressing up? I was like, absolutely. So you better come out dressed up. And I think it just provides a lot more, gives people options to talk about, obviously multifamily, obviously real estate, but then a lot of people in this industry have some sort of aviation background, whether they were a pilot, whether they were in the Army, Navy, Air Force. So a lot of different avenues to start the conversation with people. I had to leave at 10:30. There were still people there at 10:30. at the bar, hanging out, chatting, networking. But I had to go home, and we kicked off the day early on Thursday. And so on Thursday was a full day at the Flight Museum right next to Dallas Left Field. We had 500 plus there, and it felt like, Jeff King always says it good. He's like, it feels like I'm coming home. This is sort of like everyone's giving you a big warm bear hug a little bit, because a lot of people we just haven't seen in a while. And so it's just good to have everybody in one spot for the day. And so, we're going to go through it, but yeah, the listing brokers, we had state of the market, listing brokers, lenders, and then general partners speak throughout the entire day. And so, some of the feedback I got was really around, the other years people were networking more, but this year, now that after 5 hours of happy hour, everybody sat in the seat in the morning and was ready to go. So everybody was paying attention and listening intently to the conversation that we were having. So I think that, overall, I think the feedback was phenomenal.
A plus plus plus. So, as they say, James, how are you going to top this one for next year? It's unbelievable.
So we never try to top any of them. We just do different things. So it's not going to be the same. We always mix it up, and we'll put the creativity hat, and it starts the day after the conference. So
yeah, this is not done by a professional team that comes in. This is Team Old Capital, Team James Eng and Christine Eng. They start from the day that the conference is over, and they start getting ideas of places to have the event at. This year was unbelievable because it was at the frontiers of Flight Museum, keeping in the theme of Top Gun. There was an F-18. There was Apollo 7 astronaut capsule there. There was a 737 that you could walk through from Southwest. So there was a lot of different venues you could have within the venue itself. And I couldn't think of a better place to celebrate the best of the best of what we were talking about at the Old Capital Conference for 2023. So what I wanted to do, James, is I wanted to cut a little bit of time. This is about 50 minutes of discussion that Michael Becker leads up on stage in front of 550 investors with 4 different brokers. So these are the top producing brokers in North Texas. I want you to listen to a little bit about what they're talking about, what they're saying, where they think the direction of the market is going and where it is now. So it's going to be something fun for you to listen to. And then any more comments, James?
No, I think that's it. Usually we let the brokers go, and if you let brokers go, they're going to talk. So it went a little bit longer than expected, but people were tuned in, and we were just firing away questions. So I think it went pretty well.
That's great. All right, let's listen to the brokers at the Old Capital Conference for 2023, led by Michael Becker.
All right, so appreciate everyone coming. Michael Becker, SBI. We got the listing broker panel. I liked what Neil had to say. I will add on to that. I like the James kind of coined the survive to 25. I think you need to buy in 23 and 24, survive to 25, thrive in 26, sell in 27, and then you go fuck off and do whatever you want to do in 2027. So that's my plan, at least. So just adding on to that. But start with some introductions. Jacob Anderson, we got Nick, we got Mark, we got John. So Jacob, you want to go ahead and make a brief introduction?
Sure, yes. Good morning, everyone. Great to see so many people out here. Lovely venue. Thank you so much, Old Capital. My name is Jacob Anderson. I am with Newmark in Dallas, a brokerage firm focused on A, Bs, and Cs. And that's really it.
Good morning, Nick Fluellen, Marcus and Millichap. My partner and I, Bart Hoover, lead a team of 23, and we're focused kind of here in this entire region. Mostly Bs and Cs and DFW, but we do some Class A stuff in secondary and tertiary markets, and then in some of the outskirts of the Metroplex here.
Good morning, Mark Allen of GREA, national multifamily specialized brokerage, one of the largest private multifamily specialized brokerages in the country. We did about $15 billion in sales with the addition of 2 teams we're bringing on in New York City and Raleigh-Durham over the last 2 years, and I lead up our DFW workforce housing team.
Good morning, John Krebs. I'm one of the managing partners at the multifamily group here in Dallas, and we kind of attack the market from maybe Tulsa, Oklahoma City, down through DFW, San Antonio, and Houston, and then some tertiary markets spread in between there. So glad to be here.
All right. Well, I think everyone's probably aware of it, but maybe, Nick, you can just do a brief overview. What's your kind of general take on the market? Obviously, 2021, into the first quarter of 2022 was absolutely ripping. Values going through the roof, rents rising. Very different environment today. But what, if you had to summarize that in a moment or two, kind of what's your generic take on the market right now?
It is not ripping. It's interesting. The conversation I'm having with a lot of people and have had with a lot of people over the last, many years is, the market's overheated. I'm sitting on the sideline. I'm waiting for a correction. Here we go. We got our correction. I don't know what everybody thought the cause of the correction was going to be, but if it was going to be some sort of correction where values were going to drop, but financing was still amazing, obviously that was probably not a realistic, target. So I will say this: we, as you saw Neil's slide, and probably everybody out here is living, the transaction volume is way down this year, but there are deals still being done. We've done 27 deals just on our team this year. We have 20 either in escrow or agreed to, and then we have 19 that are on the market or coming soon. So it's not as if there's not transactions happening. I will say we've seen some of the best deals that we've underwritten, in the last 6 months. I mean, there are deals that are performing very well. Obviously the big summary is when interest rates double and cap costs go way up and, your reversion cap rates are much higher, right? Deals don't work. And so that's what we're sorting through and trying to figure out what's the best advice to give to people right now. But I will say it's not all bad. I do think there's deals that are trading at basis that people are going to be really happy that they bought if they can figure out a way to get it done right now. So that's a quick summary.
And then Mark, so who are your sellers? What's motivating them? What's the story behind them? It seems like a terrible time to sell if you don't have to. So why are people selling, or what are the deals that you're doing? What's behind it?
Yeah, I mean, it's no different than years past where there's going to be some level of motivation, and that motivation varies. Could be maturity coming up, could be a major fire that occurred, or a partnership dispute, or you've got equity, you're kind of aging out of the business, and you don't want to ride through another 5 years and come out of the other side of the cycle. So it really just depends.
Hey, I just want to add one thing to that, because I do think that's a common thing that people are asking. I think if you have a deal that you're in the money on, that you bought, and you had the right kind of debt, and you don't have this urgency, like to free that money up to be able to chase some of the opportunities that are on the market now or that are coming, I think is also a super valuable, thing to consider right now, because it's good to get a win on the board right now, number one, but two, the largest part of an equity multiple IRR is when you sell the property. And so if you can go out and buy a deal at a low basis today and then survive till 25 and thrive in 26, then you're gonna get a good equity multiple today, and you're gonna get a really good equity multiple when you bought these deals at a substantial discount. So I think that's a motivation.
So John, you mainly do a lot of the secondary market. So we've seen the volume in DFW hold up much better than some other markets. Is that the same tertiary, secondary, or are you seeing that just really grind to a halt right now?
No, there's deals that are trading out there. Two that, or I guess one we had on the market and it actually went into foreclosure, and then another one that's sort of in danger of being in foreclosure, where syndications that just really weren't well capitalized, and now the equity's been wiped out and even a lot of the debt. So I think there's some pain out there, like I saw that, what Neil was talking about. Then, I sold Neil a deal in Killeen, and for the longest time, we couldn't get any syndicators to go to Killeen, and now the ones that did are very happy with those assets. And the deal that Neil bought's doing really well, and there's a lot of opportunity there where you see some people having some trouble in other places. So, it's deal by deal, but just to kind of echo what these guys said, we've got one guy selling because he's a long-term owner. That's one in Bachman Lake. He's got another deal in Hearst, another deal in South Dallas that he's just ready to be out of the business. And then two others that we're selling are HUD loan assumptions, and they're developers. So they've got long-term debt they can offer, and that's the reason they're selling is to recycle their capital and go build another one.
I was going to say, it's really interesting because in 2021 and 2022, I mean, peak years, 10% of the market was turning over on average. It's typically 4, 5, 6%. So in a 2-year period, I'd say a year and a half, 21, half of 22, you had 20% of the market trade hands. That's a significant amount. And there were investors, there were buyers, owners, operators that have been in the business a very long time, 10, 20, 30 plus years, and were buying during that time as well. So no one's immune. But it's also interesting that the conversations last year with sellers and those who had bought at the peak were, well, I really need to hit that 15% IRR for my investors, but I'm at a 5% IRR. And now the conversation has shifted this year where it's like, I really need to break even. I can't lose 30% of my equity or whatever the case may be. And I mean, there could be very well a scenario where the long end of the yield curve is obviously, that yield curve is flattening right now. So rates are going up, which, erodes value, which erodes equity. And there could be a scenario next year where, you got some headwinds on the expense side as well, revenue flat, interest rates up, and then all of a sudden it's like, hey, I'm in a negative equity position. So, it's a very difficult time to make these decisions because there's a lot of different ways it could go. We could very well see a soft landing. Some things could start to break. The Fed could cut. The bond market could completely shift and interest rates come down. Or, like the quote said, it could be a pretty hard landing.
So, Jacob, all the BOVs you're doing right now, how many of them are below where the owner paid for it? You have a sense of that?
Yeah, I do. We do have quite a few. It all depends when, obviously, these assets were bought. The majority we're seeing, it's as much like you're putting your advisory hat on instead of just sales hat, and you try to do the best for your clients and paint the picture so they can communicate the right things to their partners of where they are in the market. Reality is, when you have 6.5% and you might have bought a deal when it was in the 3s, it's not going to be at your purchase price. So a lot of them we are seeing below that number. We're going through what's
half,
right, what's
more
wrong.
More than half?
75%.
How many are below debt basis?
10. So yeah, they're definitely there. It's not fun conversations to have, but it's reality, and we try to find the best path. It might be selling, it might not be, but the one thing that's so important in this market is don't bury your head in the sand. This is real world, and to the point where we're talking about selling, you might have, at not ideal, you're not doubling your money, but if you can redeploy that money in this market, this is the market a lot of us has been looking for when you're talking about opportunity. It's here now.
So anyone on the panel, who like maybe a recent transaction, who's the buyer? How did the deal get capitalized? What's working right now, like in real time?
Yeah, sure. So the institutions are more or less out. There have been net sellers here the last couple of months due to their fund requirements and whatnot. They're not doing a lot. To go back to Neil's slides, there is a ton of capital within those groups that are sitting on the sideline, but they have not been deploying a lot. We're seeing some foreign capital coming in. Believe it or not, we are actually in a great place here. A lot of places around, and that can be political pressure, it can be inflation rates and whatnot. Money wants to come here to Texas. So we have seen some of that money coming in, and private money, recycling, 1031, whatnot.
Nick, you guys sold I don't know if you're wanting to talk about it or not, but you guys sold a deal that was pretty interesting in Fort Worth recently that was got some attention, at least got my attention. I don't know if you want to talk about that or use that as like some takeaways from it.
Well, the sad thing is all these deals are interesting right now, so I'm not even 100% sure which one you're talking about. But I will say that we've sold 2 recently that have been below the price that the previous owner bought them for, millions of dollars below. Got another one in escrow right now that's probably $4 or $5 million below. So I would agree.
The price or the debt basis?
Not the debt basis, just the original price and the all-in basis. I mean, we're certainly underwriting lots of deals that are the same. As far as deals that have been on the market recently, I will say this. One that I think has been very interesting, and there's probably 15 people in this room that offered on it. So Lakeside Village in Wiley, which is a small deal, 76-unit deal, but I mean, we had 36 property tours and 34 offers on this deal. And I mean, that was a shock to us because even when the market was at its best, we weren't generally getting 34 offers on a deal. And so as we kind of discussed as this deal was on the market, man, why is this getting so much traction? I think the reason for it, and it's all private buyers, I think the biggest reason for really any deals is that it was an equity raise people were comfortable with. They were not worried about going out and trying to buy a deal and then falling flat on their face trying to raise $15 million, $100K at a time, right? Like that was very easy to do 12, 18 months ago. It's very intimidating to do now. And so I think these sub $20 million deals and even sub $15 million deals, which have always been attractive, nice deals, they're just a little more attractive and a little hotter right now than they were previously because for people that are like, hey, I would like to be doing something, that's one that everybody feels good about. And even if you had to bring in somebody else to help, it's still very manageable. And so now, are they going, way above what we thought they were going to go? No, it's not. It's not the exact same type market that we were in before because they are still debt constrained more so than previously. And of course, people have swung the opposite way and don't want to put bridge loans on these deals. So they are kind of debt constrained. But I will say we were not expecting that type of return. Likewise, larger deals that we have on the market, we are getting good activity on, candidly, because we're working really hard on them. We have a little more time than we've had in previous years to work on deals. So we're working really hard on these deals. But again, the equity is always the concern. And I will say from the point of view of GPs potentially in this room, or even LPs, but especially GPs trying to raise equity, if you're going to go out and try to raise $15, $20 million, you better have a really compelling story. And so I think what I've learned is that the cap rate is pushing higher on some of these larger deals because they need a compelling story to go take to equity. And otherwise, everybody's just going to kind of sit around and wait. So that's what I've seen in the two kind of most recent real-time deals for us.
And then, so real-time, Mark, how have the terms changed? I mean, it used to be, certainly 6 figures, maybe 7 figures in earnest money, day one, limited inspections, all that BS. And I'm assuming that's by and large gone, right?
I mean, generally, looking at our numbers, I think it's right around 80% of our deals are still going with some level of non-refundable earnest money. It really depends on the deals. Granted, I would say, most of our deals this year have been on obviously values have shifted, I'd say 30, 40%, but, they've just been smaller deals as far as unit count in years past, and I'm okay with it. Like, you go new debt, Freddie SBL, you can lock at application, takes out some of the risk. On the larger deals, loan assumptions are a little bit more stable. But all in all, I think it just depends on the scenario. Is it priced to meet the market? And if it's, a compelling location at a market price, then, you're going to have a lot of demand on it, specifically in that sub $15 million space. So we're still seeing non-refundable earnest money, but it's not the 2-3% plus that we were seeing before. And I would say generally, a lot of people from a physical inspection want a limited access period and whatnot. But outside of that, terms are, as far as timing, terms are the same.
I see a lot of deals get extended that don't have extensions to buy more time. And are you seeing deals with hard money get retraded?
For us, not all that much. I mean, again, it just depends on the deal. I mean, one that specifically comes to mind was just a C property and probably a D location. So a little more of a challenging deal to sell in this environment. But, generally, no.
So, John, volume's down 70, 80%. Like, how and when does that change? Like, when do we start seeing more pitches to look at?
I don't know, but I'm sad about it. I'm also sad because James told me I'd worked on a video where I was doing a voiceover for Dave Chappelle in Con Air, and it's not going to play.
Me too.
You were in that one? Yeah. Well, y'all aren't going to see it. It's too risque for this crowd. Yeah, maybe another time, maybe offline.
Happy hour. James got a special announcement. The video's a happy hour, so you got to stick around all day, I guess.
So, we're down, 70%, just about with the number compared to where we were last year as far as transactions. We've seen it pick up here at the end of the year, kind of like what Neil mentioned, that, while pricing has been sort of hard to find. It seems like sellers are coming around a little bit more. You've got, I mentioned the folks that, like we're selling another one the folks have owned it 5 or 6 years, so they're in the money pretty good, and they're going to take the proceeds and roll that into a bigger deal. So there are deals happening. It seems more now than maybe 4 or 5 months ago. I think we just need these interest rates to come down some, and really I think we're going to see some more of this pain that I'm talking about. Where the pricing is either at the debt or maybe there's some equity to get back that people are going to be forced to sell on.
Right. I don't know how the rates just fall that much. It seems like the market kind of, my impression, the market kind of met where the bid-ask spread was wide and it narrowed 60, 90 days ago. Then all of a sudden the rates went up again, and then the spread gaps out because the sellers kind of came to reality. So I don't know, Mark, if you've seen that.
Yeah, we just need a sense of stability. When Treasury yields came down in March, and they were pretty stable through June, obviously up and down, but relatively stable to what we've been seeing, that helps make transactions. The bid-ask spread closed, and like you said, now it's widened. Just as a data point, in Dallas-Fort Worth, there's been 183 deals listed year-to-date at this point. 101 of those have not got to the closing table. So that's 55% of the deals in the market that have failed. And, maybe it's some of how the brokers are pricing the deals, but, it's also because of that bid-ask spread.
So, Nick, Jacob, we all were doing deals in 2008. So, Jacob, I was on the banking side, you're on the principal side, and Nick, you were selling apartments. Is this 2008? Is this turning into 2008? I mean, that was a mess.
Yeah. I'll tell you what, it's been so good since that time. It's like having a kid, It's like you forget how hard it is at the beginning, otherwise you'd never want to do it again, it's been so good, you don't even want to remember what it was like back then. But I don't know. It's interesting because I think we've got a more sophisticated investor pool than we did in 2008. I mean, we weren't doing conferences like this in 2008. There's been a lot of education poured out into this market, and this market has just grown so much. So I do think it feels better than 2008, because we are smarter. We know a little bit more how to navigate the problems, the challenges. We've got a great, team of specialists that can kind of help in every area. And so and then the fundamentals are really good in Dallas too. I mean, so that part of it all feels good. I mean, to me, this distress is whatever distress there is in the market is almost entirely debt driven, right? I mean, that's not a mystery, but if you bought at a 3 cap because interest rates were in the 3s, then it's not going to work well when they're 7. So it's just doesn't matter how smart you are, it just doesn't work math-wise. So I do think it's better now. I think people are more equipped now. I think there's more buyers in the market now. So how long is it going to last? I don't know. I mean, I think the one bullet point that I cling to on that slide and that I bring up a lot as I'm talking to people is it always comes roaring back stronger than before. And if you believe that, and there's a lot of data and a lot of history that would indicate you should believe that, but if you believe that, then to get a chance to buy right now when everything's essentially on sale is going to bode well. When people say who's going to be the winners right now, like when we look back 2 or 3 years from now, it's going to be the people that were figuring out a way to buy deals. As hard as it is to raise equity, as hard as it is to structure debt, those people are going to end up being the winners. So I think we're better off than we were in 2008, but I think, again, a lot of it's just the investors and the people probably are better equipped to navigate it.
Right. I don't think we're at 2008. I mean, I think that was bad. Everyone could buy a home. The fundamentals of debt were bad for a long time. We had the debt fund come in for an 18-month window, and if you bought in that 18-month window with a debt fund loan, then you got some problems, right? But goes up, it can come down too, so the rates can come down, it can stabilize. And I think if you buy a deal at the peak in 07, 08, by 13, 14, you're back in the black. So it doesn't last forever.
And people tend to forget too. I mean, there were operators that were foreclosed on during that time, and have come back even stronger. So,
several still in the marketplace. I can't believe they still do business.
And history always forgets too. I mean, in 04. The Fed funds rate was 1.25. The Fed hiked and paused at 1.5 to 5.25, and paused in 06, 07. And subprime loans were 2-year fixed, 28-year floating on credit-worthy borrowers. And obviously, we know what happened there. So 15 years goes by and a lot of people forgot, including ourselves.
You know, I will say one other thing that's been really interesting. We've discussed this even in the last few days as we've looked at a couple deals, and I'm sure, Jacob, you guys, are having the same discussions. But we looked at a deal for a client we sold a deal to a couple years ago. He has executed his business plan perfectly. His income's up $600K, I think, in the last 2 years. Really, really impressive job on the income side. But I think the other issue is expenses, right? When you look at an OM, you get variable expenses and fixed expenses, or controllable, non-controllable. And obviously, we didn't anticipate, and I don't think many GPs, I don't know that I've ever looked at somebody's underwriting and saw somebody write, well, I'm going to underwrite a 200% increase in insurance, or I just have never seen it. You'll never win a deal, so you can't underwrite that way, or you couldn't historically underwrite that way and actually win a deal. But what was interesting is the $600K in revenue was offset by about almost $500K in expense growth that wasn't expected. And so, it's like you could almost think, I was able to take this rise in these interest rates and offset it because I did such a good job operationally, but they're not even really getting that much credit for all the operational success because of the rise in expenses. So it's just a lot of factors all at once, and so it's I think for our position, it's hard to advise people in exactly what the right plan is right now. It really is dependent on the partnership and depending on the LPs and depending on the asset. How much do you really believe and like the asset moving forward? That's just another thing that I think is compounded the mess that we're in right now, is that maybe we didn't fully expect. We didn't expect an underwrite a big freeze, killing us on insurance. So
anyone on the panel. So we've seen. Is there any good news on expense front? I mean, I'm on the hill I'm dying on is 2023's peak property taxes. Like that just has to be. There's just no way. So we should get some relief in 2024 from a combination. We're seeing the millage rate compress. There's a new tax in Texas. November will be voted in with a further reduction of 3 to 6 cents on the ISD millage rate. And then now some of these deals have traded high and now they're trading lower. There's your comp, and it might take you 12 months to go fight DCAD or Tarrant CAD to go get that value. But at the end of the day, you're going to get the taxes. Is there any other expenses you're hearing from anybody that might be some a glimmer of hope here on the expense front, Jacob?
Well, I think one of the things we saw during COVID, and you went in to buy your deal and you had your CapEx budget set up for doing upgrades. Now, some of the things we heard earlier with the cost of just getting product over and getting like the shipment, the shipping delays, whatnot, I think that really pushed the expenses too. The numbers we've heard here from, let's say, the last 24 months, they have been much higher than the normal in turning a unit and upgrading it. The other part is probably payroll. It got super, super tight in all parts of the industry. I think going forward, we're probably seeing that stabilizing a little bit more and not running as wild.
So when I started the business, we had four property grades. We had A, B, C, and D. And then somewhere about 5 years ago, all the D-class deals went away. We just had A, B, and C. And then when I started, there's about a 300 to 350 basis point spread between the top of the grade to the bottom of the grade in cap rate. And then last few years, they were essentially, really tight within 50 or 100 basis points of each other. Now that we're seeing, some interest rates rise, we're seeing cap rates expand. Or was my thesis right? Are we stickier on the top of the grade and the lower inferior locations, inferior product, chiller, aluminum wiring? Those cap rates are blowing out wider. Is that what you guys are observing?
100%. I mean, this is the biggest delta I can recall in the last decade between A, B, and C. I mean, it's literally 100 basis points plus across each of those segments. So
right.
I mean,
it's very different in the Bs, the 80s and 90s versus the Cs.
Very different. Very different. I mean, and again, I think you start now. Everybody's really dug in on risk at this point, right? I mean, the market's tight, so now everybody's really strongly considering risk, and so you have to price in risk on a C deal right now if you want to sell it. So yes, I think the cap rate for the first time in a long time is notably different between between certainly B's and C's and even A's and B's as well.
So in your mind, what's cap rates right now across the grade? Like what would an A deal be, a B, a C?
I mean, I think A's are probably low fives, and I mean, if it's really premium, it could be lower than that. But I mean, again, the institutions aren't really doing much, so it's going to be low fives. I think you start getting into the 80 stuff, it's high fives, low sixes, and C stuff is probably 7+, which it sounds insane. I mean, I did not think 2 years ago we would be up here talking about the ability to buy 7 cap deals in DFW, and I don't know that we will 2 years from now. But right now, today, there is an opportunity to buy deals at 7+ caps.
So what's the window? Like how long do we have? Anybody? All of you?
Well, one thing I think that's an important factor, and we saw it on the slide earlier with all this cash sitting on the side, when that is getting released, it's too late. The competition on these things here will drive the cap rates down, no matter what. So the window it can't be really planned. It's not going to be like 10 boxes that are lined up and picture perfect. But if you can hit it before that capital get pushed into the market, I think that's your window. And it's quite frankly starting right now. It's really hard to plan right now when we have 100 basis points or 50 basis point raising in a week. What's tomorrow going to be? But when we're starting to see it just level out a little bit, hopefully that's going to be here in the Q4. I think that's going to be a pretty good time.
Last year when I sat up here, I said just kind of a rule of thumb on B deals, like if I could get somewhere around 55% leverage, I could probably make a deal. This was 6 months after the Fed started hiking. C deals, 65% LTV, I can probably make a deal. And I think since then, it's probably north of 60% for a B deal and north of 70% for a C deal, which means that spread over the interest rate has widened a little bit, and the market has kind of come in as far as those spreads go. But
what makes cap rates a little bit hard is because of assumable debt. Like Neil mentioned, locked out. Could you imagine if fixed rate, debt for multifamily was not assumable? That would be awful. So when we're looking at deals, we're trying to find ones that have some assumable debt, and then your cap rate can be adjusted some.
What does that look like? Because I don't think I could pay the market's a 5.25 for a Class A, and I got a new debt's at 6, and I can assume a 4. I don't think I could pay a 4.5 or a 4.25 because that debt's a burning match, and at some point it's going to go away. What kind of premium to cap do you get?
Well, I noticed you never called me back on my Granbury deal. You reached out. So that Granbury deal's at 3.5 HUD.
Yeah.
So we've got it priced at 5.
You got 30 years there, right? So
yeah, with a 40-year AM, and
so you got a price at a 5.
Yeah, we got it priced at a 5.
And what's the leverage on that? Like
about 70.
About 70. Okay.
Yeah. So that's what I'm saying. The debt and this, we're here because of old capital, and that's such a big driver of value that the cap rate's a bit of a moving target, because if you're talking about new debt, yeah, it's tough. It's tough to get a seller excited about a 7 cap.
But what if that was like a 4% rate with 4 years left on it or 5 years left on it? I mean, you're not going to get that big of a delta on your cap, or am I wrong?
I'm going to try.
And then
I think the thing to remember too is that we can certainly speak to the masses, right? But all it takes is one person to fall in love with a deal. Now they're a little less likely to fall in love with it today than they were a year ago or 2 years ago. But I think that's always been the case, right? It just takes one. There's only going to be one buyer. So if somebody believes in a deal, a location, a business plan, and is going to be a long-term holder, then yeah, maybe. But we're as a team right now is we're not pricing for the needle in the haystack, right? We're pricing for reality. Like, we don't need the practice. I've been doing this for 20 years. I do not need the practice of going and showing a deal and touring and making 500 calls only to have a deal not sell, So I think it's time to be real. People have to ask those hard questions. Would my LPs rather, get 70% of their original equity back, or would they rather a capital call? And I think that's a question people are asking right now, and you better have an answer to. I think that people are making the mistake of just waiting and waiting and waiting. And I've told people too, you can't wait and assume the first buyer is going to close. We used to be 98% first buyer in escrow is going to close. And now I'm like, I hope they do. We're going to vet them as much as we can. But, they may have been successful raising equity, 30 deals out of 30, but they aren't in this market, right? So I'm like, you have to give time for and expect maybe a deal not to work out perfectly right now, and there are going to be some issues. So I just think those are the hard conversations that have to be had, as partnerships right now.
So it just takes one. That's how we all got married, right? It just takes the one, right? So I don't know if James, we have a mic for questions in the audience. We got about 10 minutes, I think, left. But right now, like, what's the best part of the market? What are you focusing on? What do you spend your time on right now, Jacob? And Nick just said that, he doesn't need the practice. I don't think anyone on this stage needs practice anymore at this point in our career. So, like, what gets you excited about bringing a deal out? What would have you not take a deal out right now?
Sure. I think we need to all be on the same page. So I'm not very excited to go out on a complete limb and say, hey, you need this number because you need it. It's really about what the market will provide you. So again, I'm not in the business of driving all over DFW and touring these deals and have nothing to show for it. And quite frankly, I'm not doing a service to the owners running all over their properties and disturbing their staff doing it. So it is about having those conversations up front and be on the same page and say, hey, you understand the market, I understand the market, and this is how it's going to go down. The one thing I would also encourage everyone that owns deals right now, and they might be looking at selling, time is a factor. And the shot clock is running. So if you have a deal that you have a maturity or a rate cap coming up, I can't help you if you have 15 days left to it. It takes time in this market, and to do it right, got to underwrite it early, set the expectations early in order to be successful. So we work a lot, and having these hard conversations with buyers. What is real, what is not real? We're not going to go out just and underwrite to a Hail Mary where everything needs to be perfect. We're not in that market. So that's the starting point, and those are the deals that makes in this market.
All right, we're going to take a couple questions. Maybe introduce yourself and then go ahead.
Thank you, James. Paula Sabersula, I'm in Austin, and we're looking for deals. And so I get calls from other groups looking for money because they can't make their raise. They're extending their deals. So what are the kinds of conversations are you having with them to get the sellers to decrease more? Do you go as far as explaining to them what's on the horizon? I mean, do they know? Are they looking at IRR? What can you help them with in order to get that conversation going? Thank you.
Yeah, I mean, first of all, the conversation needs to happen before we even start, right? Like, hey, these deals that we've had on the market right now, the 10-year's gone up 55 basis points since we've been on the market in the last 30 days. Like, that's a material difference. Like, so did we talk on the front end about debt and the impact it's going to have on the value? And is that a surprise when we get to the finish line and, oh, wow, these are, it's a conversation that needs to happen at the front end. It's a conversation that needs to be happening throughout the marketing. That feedback needs to be there. At some point, somebody's just going to say it's better for me not to sell. And I understand that's a real possibility. And obviously we generally don't want to work on those deals if we think that's what the outcome's going to be. But there are certain scenarios where that does make sense. The buyers struggle to raise equity. It's certainly we've got multiple deals that it's like, okay, well, it's taken time. The seller gave them more time, and then the rates went up while they, and then they want a price reduction because they can't get the equity, and also because their loans, gotten worse over time. And so it's a double-edged sword for a seller to work with a buyer because they're shooting themselves in the foot by giving them more time. Time has not been our friend in the last year on any of these deals. So. There's no magic, there's no magic formula. It's just communication and motivation. And if we're conveying that clearly and the sellers really see either, the value of selling now or what else they can do with that money that may put them in a better position, then deals are happening. Or if they don't have a choice, right? If the, rate cap is expiring and the loan's maturing or whatever. But that's it. It's just, we're just trying to over communicate right now more than we ever have. I don't want to say we were lazy in the previous market. We just didn't. It was like 20 people trying to buy the same deal. And so it was a very different deal where it's like, well, you don't buy it, she'll buy it. If she doesn't buy it, well, then she'll buy it. And it's not that today. We really are trying hard to get it right on the front end and to shorten the time frame as much as we can, get as comfortable as we can with the equity, get as comfortable as we can with the variables. Do you know what your insurance is going to cost? I know the existing owner has got a policy expiring in 3 months, but do you know yours might be higher than that? And did you underwrite this tax increase? And all of these different variables. But at the end of the day, we can't control the Treasury. We can't control some of these other factors. So
maybe we'll wrap up just with go down the line, put on your buyer hat, give some advice. Take that buyer hat, put on your seller hat, and give that person some advice.
For me, I think it's questions like that and answers like that. We might be at peak pessimism, so maybe it's probably a pretty good time. Seriously, rates have gone up a lot, but they go up, they go down too. It's going to wash some guys out in the, that shouldn't have the structure that they have. And, I think Mark's right. No one's immune. There's challenges all over. Even the best operators have some challenges, but I'm getting bullish. I'm fully convinced you buy stuff right now, 2024, you're going to be handsomely rewarded. I don't know what stops Texas. Neil, it's like we read the same hymnal this morning. You're seeing supply is going to be large in 2024, especially a guy that owns a lot of nicer stuff. But they haven't been able to get capitalized the last 6 or 9 months on new development. Takes 2 years from construction to CO in Texas on a generic deal. Those deals all deliver between now and basically Q1 of 2025. 24 is going to suck for rent growth. 25 is going to be pretty good. I think 26 is a banger year. Selling 27, go fuck off, do whatever you want to do, right? That's the basic story.
I do have one question for you, Mike, since you're the principal on the stage here. Are you locking in fixed rate loans at these rates today, or are you, as crazy as it sounds, saying, hey, maybe I should put a bridge on some of these deals?
If I could float, I'd float. But you can't raise money with that story. So what I made a mistake at the beginning of the career is we took 10-year debt, got 1 year IO, 10-year debt, 80 levered on C stuff, thinking that at 5% it's going to be accretive when I go sell it. The guy would want to assume it. That was the absolute wrong thing to do. Ken, you made a fortune in this room just buying all my deals because I was dumb, that way. And so, I think what we're doing now is we're shortening the duration. So I think it's hard to go raise money with floating rate debt. A lot of variables, cap costs are expensive, but I wouldn't be putting 10-year money on, right? At least not with defeasance or yield maintenance. Get something with some prepay flex or shorten the defeasance yield maintenance. Get a 4.5-year defeasance. Don't get a 9.5-year defeasance because getting to sell it in 3 to 4 years. You got a year or two yield maintenance to deal with. It's not great, but it's not a killer like if you had 7 or 8. So that's what we're doing.
Mike's got a leg up too. He's a preferred agency borrower. So the rest of you are borrowing at 6.5%. And then he's probably buying down the rate too and borrowing at 6.
Yeah, and that's one thing that we've been doing. We did 4 deals this year, two 5 years, 2 7 years, 3 Freddie, 3 Fannie, 1 Freddie, all fixed, all 65 of cost, full term IO. We bought each one of the rates down. Started at 475, had 2 about 530. This last one's 580. That was 30 basis points ago. So, but you could buy the rate down. It's usually accretive. If you're buying the rate down, meaning you'll get more in loan proceeds by buying the rate down. The agencies like it because it shows that you're putting, actual more cash on the front of the deal, and it also protects your back end on your defeasance. Yield maintenance is not as risky because you have a lower rate when it comes time, and hopefully the 10-year Treasury is back to 50 bips, so we all make $1 bajillion again. So, yeah, that's what we're doing.
So if I was a buyer, if I'm put on my buyer hat, in this market, I'd be looking for loan assumptions. I'd be looking for developers. Sometimes these development deals, they'll discount the rents and lease them up, and then on a renewal, you can actually raise the rent considerably. I was talking with a guy yesterday about this because there is such a thing as it's not comparable. There's nothing to comp it to. They are the highest in the market, and he was telling me about some $300 to $400 trade outs he was getting on new rents. So I did want to ask too if I could get a show of hands of who thought they were going to buy a deal in the next 6 months in this room. Okay.
Who's bought a deal as a GP? Who's bought a deal this year?
Yeah, that's what I was. And then who's selling a deal in the next 6 months? Just you, Ryan. Okay. Oh, we got a couple of sellers too. 3. Okay. And then if I put on my seller's hat, it would be to get multiple BOVs. You got a lot of talented brokers in this market. So we all kind of see things differently. Sometimes I'll miss something. Sometimes somebody else will. So you can look at a lot of different opinions and have a lot of conversations. And then if you could put on some sort of a long-term fixed rate debt like a HUD, there's another guy doing this strategy where they're going ahead and teeing up the HUD loan and then going to offer it for an assumption at a higher leverage, higher amortization, better rate. That's my advice.
Yeah, so starting with the buyer cap, and we have talked about that. One thing, I think, we're talking about these macro mechanisms with the interest rate and whatnot and the capital stack. And that goes with everyone that's doing a loan in the world and in the U.S. It's challenging. The good thing we have here is still the DFW market and the Texas in general and seeing where that's coming. And that's really where I think it kicks in for regionally and looking at 25, 26. We're going to be in a really good spot. And again, you have a certain window, and hindsight is so easy when you look back and I should have done all this in 2012. Well, yes, you could have, but you didn't. So that's getting out there and believing in that and still be smart about it, but taking that opportunity, I think that's going to be super important, and there will be some movement for groups that does that and kind of take it to the next level. When you turn it over to the seller side, I think it's very individual where you are. That's where the capital stack comes in again. You can't look to your neighbor and say, oh, they're not doing this, so I shouldn't be doing that. It really comes down to your situation, your cash flow, your loan, your timing, and there's a right and a wrong time to sell. And if you have 3 years left and you have money in the bank, you might not want to sell right now. You're going to hang on to it. But if you have 6 months left and you're betting on the interest rate to go down to 4, so it makes sense, good luck.
Yeah, I would say if I was putting on a buyer hat, I ask people this sometimes. I'm like, well, all things being equal, would you rather buy a deal at a 5 cap or a 7 cap? I mean, seems pretty obvious. You can buy a deal that you would have bought for a 5 cap today at a 7 cap. This debt situation is temporary. I mean, it's not going to stay this bad, and we know that. And I think pretty much everybody in this room believes that. So if you really believe that, how do you start positioning yourself to raise equity and get that story out there that, hey, we're buying on sale right now. So whoever's able to do that, I think is going to be really happy in a couple years. From the seller side, I think it's just, again, if you're in the money, think about what else you could be doing with the money, because I'm guessing staying in a deal that you've already executed your business plan on and you're just going to tread water, I mean, that's possible, and it's not that may be the right solution for some, maybe the wrong solution for others, but I do think if you're looking at a 5-year perspective, redeploying that capital with some of these deals that are available right now could be a really smart thing to do. And then also just ask those hard questions. I'm an LP in a lot of deals. In fact, I saw a slide about the office building being terrible. I had a 0.0 equity multiple on an office investment I did before COVID. So my last office investment ever. But, I get it. It's some of these deals are going to be better. Some of them are going to be worse. Like, in hindsight, it was not the operator's fault. It just, COVID happened and that deal went in the dumps. It's the same right now. I'm not blaming operators for the majority of the issues that we have right now as an LP. And so if some of them call me and say, hey, which would you rather? So you want 70% of your money back or you want a capital call? I'll take the 70% of my original money back. Now, again, that may not be everybody, but you need to take the temperature of your partnership instead of just assuming that everybody is going to really revolt and not want this. And don't get yourself in a bind because, again, time is not our friend in general right now, especially if you've got a rate cap coming up in your future. So that's my summary.
All right. Does that, Mark, anything to add? If not, we'll let everyone move on to the next funny video.
Just on just to kind of piggyback on that, I've been saying play the odds. You can't predict the future, but if you look back in 2021 at with the Fed funds rate at 0, Is it going to go down? I mean, some people, I guess, were saying we're going to be in a negative interest rate environment, but it's more likely to go up. So, expect that you're going to have some more headwinds with expenses, specifically taxes, insurance. Expect that, interest rates are going to go up. And I've just been trying to advise whether you're going to sell or refi, take action yesterday. From a buyer perspective, I do believe in the market. Obviously, yields are compressed here in DFW compared to other places across the country because we have, an incredible amount of demand here. Still, companies are moving in despite, economy slowing down. And it's still relatively affordable to other places in the country. So people believe in the growth story. I do believe there are deals out there that are viable. Just be convicted in your forward projections of NOI. You got to be in this market to be buying. So the operational market's changing. It's tough to, pro forma hire, go in and increase $200 rents on a deal that's traded 3 times in the last 7 to 10 years. I think everyone's doing the right things, coming here, absorbing information, and networking because everyone should be going around, just saying, hey, I'm looking for this kind of deal. These are the returns I'm looking for, and trying to get commitments for capital to help in your capital raise. So good on you for being here, and thanks for everyone coming out.
I appreciate everyone's attention. I'll turn it back to James.
All right. Thanks a lot, guys.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.